You find a home listed at a price you think you can afford. But that number is not what it costs to buy it. There's a whole layer of expenses nobody puts on the sign. Closing costs, inspections, ongoing fees, and they can add tens of thousands of dollars and blindside first-time buyers right at the finish line. Today, the real cost of buying, the debt-to-income number lenders quietly judge you on, why you still need an emergency fund after closing, and the inspection and HOA gotchas that catch people. If nobody ever walked you through this, that's normal. That's why this channel exists. Quick note, this is general education, not financial, mortgage, tax, or real estate advice. I'll point you to official sources like consumerfinance.gov and HUD.gov. And for your situation, check with a qualified professional. First, the big idea. Buying a home has two kinds of cost: the money to get in the door and the money to keep living there. Getting in means the down payment plus closing costs plus cash reserves. Keeping it means the mortgage plus taxes, insurance, maintenance, and sometimes association fees. Most first-time buyers only plan for the down payment and get ambushed by everything else. So the goal is to see the whole picture before you fall in love with a listing. Start with the one that surprises people most: closing costs. These are the fees to finalize the loan and the sale. Things like loan origination, appraisal, title, and taxes. They're commonly described as roughly 2 to 5% of the loan amount, and they're due at closing on top of your down payment. As an illustrative example, on a $300,000 purchase, 3% is $9,000, cash you need in hand beyond the down payment. Your actual costs vary by loan and location, so get the official loan estimate. Next, the number lenders judge you on. Debt to income, or DTI. It's your monthly debt payments divided by your gross monthly income. Lenders look at two versions: the front-end ratio, just your housing payment, and the back-end ratio, all your debts including the new mortgage. Many lenders prefer the total to stay under about 43%, though limits vary by loan program. The lower your DTI, the more comfortably you qualify, and the more room you have to actually live. Check current guidance on consumerfinance.gov. Here's why DTI matters for you and not just the bank. Qualifying for the biggest loan you can get is not the same as being able to afford it. If nearly half your gross income is committed to debt before groceries, gas, and savings, a single surprise can tip you over. As an illustrative example, on $6,000 a month gross, a 43% back-end ratio is about $2,580 in total debt payments. Aim to borrow comfortably under the max, not at it. Let's total the cash you actually need to close because it's more than the down payment alone. Using an illustrative $300,000 home, a 10% down payment is $30,000. Closing costs, around 3%, add roughly $9,000. And lenders often want to see cash reserves left over afterward. Add it up, and you can need well north of $40,000 in cash to buy a $300,000 home. These are illustrative numbers to show the shape, not a quote. But here's the mistake that quietly wrecks first-time buyers: draining every last dollar into the down payment and closing, then moving in with an empty emergency fund. Homes break. The water heater fails, the roof leaks, the furnace dies, and now there's no landlord to call. It's all on you. Buying a home does not replace your emergency fund. It makes it more important because your surprises just got bigger. Keep a cash cushion after closing, even if it means buying a little less house. In about a minute, I'll give you the first home checklist to screenshot, every number to run before you make an offer. But first, the rent versus buy reality check and the gotchas that hide in the inspection and the HOA. Quick context: buying isn't automatically smarter than renting. Renting isn't throwing money away. It buys flexibility and offloads maintenance and big repairs onto the landlord. Buying can build equity over time, but it comes with transaction costs and upkeep, and it usually only pays off if you stay put long enough to outrun those costs. A common rule of thumb is that buying tends to make more sense the longer you'll stay. If you might move in a couple of years, renting can genuinely be the better financial call. One number that trips up buyers who put less than 20% down: private mortgage insurance, or PMI. It's an extra monthly charge that protects the lender, not you, and it's common on low down payment loans until you build enough equity. It's not necessarily a deal breaker, but you have to budget for it because it raises your real monthly payment. Ask your lender exactly when and how it can come off. Now, the one thing nobody tells you: the inspection and the HOA can cost or save you more than a fraction of a point on your rate. Never skip the home inspection. A few $100s can reveal a failing roof or foundation issue worth tens of thousands and give you room to renegotiate or walk away. And if the home is in a homeowners association, read the rules and the fees before you sign. HOA dues are an ongoing cost. They can rise, and special assessments can hit you with a big surprise bill for shared repairs. And don't forget the costs that never stop after you move in. Property taxes and homeowners insurance often get bundled into your monthly payment through an escrow account, and both can rise over time. On top of that, a common planning guide is to set aside around 1 to 4% of the home's value each year for maintenance and repairs, an illustrative range, since older homes cost more. The mortgage is the floor of what a home costs, not the ceiling. Budget for the whole thing before you make the leap. Here's your first home checklist. Screenshot this before you make an offer. 1. Budget closing costs of roughly 2 to 5% on top of the down payment. 2. Run your debt to income and borrow comfortably under the max. 3. Keep an emergency fund after closing, not just before. 4. Honestly compare renting versus buying for how long you'll stay. 5. Never skip the inspection and read every HOA rule and fee. 6. Budget the ongoing costs: taxes, insurance, and maintenance. Run these 6 and you buy with your eyes open. That's the map. The listing price is just the entry fee. Closing costs, DTI, reserves, and ongoing upkeep decide whether a home is actually affordable. If this helped, the free adulting starter kit in the description has this checklist plus a simple budget template. Next up, the budget system that actually works, and why 50-30-20 is a starting point, not a rule. Subscribe so you don't miss it, and check consumerfinance.gov and hud.gov for the details.